Good day and welcome to another What's Up with the Market session. We're going to look at market status as we normally do, 24th of April. And got to remind you before I get into this that I don't use any of this analysis or none of it is used in SPA3 Investor or SPA3 Trader, and none of it is used. The analysis I'm going to go through today is used to make any decisions in ASX and USA public portfolios on using SPA3 Trader or SPA3 Investor. And I don't use any of this analysis to make any decisions for what I buy and sell, or when I buy and sell, or how much I buy and sell in any of my own personal portfolios as well. So it's exactly the same. I trade exactly the same as the way I do in the public portfolios. And just I'm a mechanical trader and precisely follow our systems. Everything we covered today is a general investment advice nature. There's no specific or personal investment advice in what we go through today. Right, on to the Dow Jones. We've had a retracement, as you all know, so a bit of red. We've had, I think, 6 or 7 red bars or down days in a row on the US indices, and a couple of green ones, or 3 on the Dow Jones, 2 on the S&P 500, as you'll see shortly. And what we're keeping our eye on here, as we finished up a couple of weeks ago when I did this last What's Up with the Market session, is how deep this retracement in the indices is going to be after the run-up that we had from here, around about the middle of the screen all the way to the peak over here. And now we've had a retracement, which is absolutely normal for the way the markets operate. If we think from the market's perspective and we think with a probabilistic mindset, then we know this is going to happen, right? And it's how we react to it, how we feel when this happens is an indication of how in tune our mindsets are with the market. So what have we had to? We had a couple of up days here, and the depths of this retracement in the Dow Jones is just past the 23.6% Fibonacci retracement, so which is shallow. There's the 38.2. As I've said before, I'm happy for 38.2% retracements. Start going beyond 38.2% retracement, and you're starting to now think this could turn into something a bit more drastic than just a normal retracement, a down leg, if you like, after an up leg. That's the way the markets move. They go up in step, and this, what we don't know now, and this is the theme for today's session, is whether this is just a normal up leg, if you like. So we've come down, now we're going up, because it won't just keep on going down in the straight line. So we were going to have an up leg like we're having at the moment, is whether we have found a base or not. That's what we don't know. So this will play out over the next 2, 3, 4 weeks. We'll form a peak somewhere along the line on the way up to potentially a new all-time high again. And depending on where this next peak forms and where the next trough forms is really going to tell us what is going to happen over the next few months. So at this stage, the retracement is shallow. This up leg is normal. That retracement is 100% normal. And now we have to see how it plays out here, whether a base forms here or not. So S&P 500, the retracement was bang on the 23.6% line, the Fibonacci retracement. And as I said, this is all pretty normal. Volatility is up a little bit. This is the ATRV 21-day on the S&P 500, as you'd expect, with 6 red bars as we've had on the S&P 500. So keeping an eye on how deep this retracement goes. In the meanwhile, it's certainly, you'll see there are some indicators that are showing some weakness. So the breadth of market and the sentiment indicators that we look at. So moving on to a breadth of market, new high, new low, a little bit of a dip over here, not too bad. This is a pretty smooth line anyway, but we can just tell that the line, the gray line here, is starting to dip towards this trend line, but it is still above it. So that would be expected with the retracement that we've had in the S&P 500. The cumulative advanced decline line has dipped. So this is the number of stocks advancing versus those declining on any given day. And you'd expect it to when the market falls, because there'd be more stocks declining than rising. And this moving average I've got on here, just to smooth the line a bit, has just dipped towards the end. But nothing to take away. There are no divergences there, so that's pretty normal for what you'd expect in this market. This is the number of stocks in the S&P 500 that are above their 150-day moving average, and same sort of thing you'd expect with a market decline like we've had. A number of stocks would fall below their 150-day moving average, but it's still at pretty high levels. up at 3/4 of the stocks above their 150-day moving averages, and a pretty sharp retracement. Something that just noticed over here is that this just look bottom chart. This is the S&P 500. The S&P 500 was still declining when we actually stocks rising above their 150-day moving average. So there, the top graph rising while the S&P 500 falling. That meant that there were some probably smaller cap stocks that didn't have as big an effect on the index were rising, but obviously didn't have the effect on the index to be able to turn it around. And now we've obviously had some of the larger caps do that in the S&P 500, and they've now turned the index. So just little thing to note, and these little small signs are just showing that there was a bit of strength in the smaller caps. Right, the US dollar index, key indicator. What's happened here is the SIROC down here, the smooth index rate of change of the ratio, the relative strength ratio, stocks and US dollar has turned up. So that's why I put this red line over here. And typically, when the US dollar rises strongly, markets tend to fall. So we've had the US dollar rising into this level over here. You can see the relative strength line, which plots a day-by-day ratio, started rising back here, and stocks have fallen. Now we've just had the US dollar fall a little bit, and just in the last couple of days, you can see equities have risen as well. So pretty strong correlation, negative correlation between these two price actions. And what we don't know is how long this is going to be. Are we going to see weakness in the US dollar and strengthen equities, or the other way around? But still a warning sign here, even though, remember, the retracements are still pretty yellow. I do have pretty rate of change. This SIROC over here, pretty. It's a medium-term one, so it's not that sensitive, but it's still being sensitive enough to actually change it. So this could go on for a while, or it could turn. There are instances where the indicator will turn straight down if ratio turns. So if US dollar falls, stocks rise, we're going to see this smooth index rate of change drop. But at the moment, just take note that this is a risk-off signal in the shorter to medium term, but we don't know how far the indications go. Right, this is growth. Here's the Russell Value Index at the bottom, Russell Growth top. Your naked eye can see that they were both falling in unison, but the growth was falling by more than the value, which got the ratio here to fall between the two sectors, and that caused the SIROC here to fall. So that risk on came back here, which was a little while ago. That was the first one that showed up in when was that? That was back in the 5th. Now let's see. So that's a sentiment indicator, if you like, that's showing weakness. And now this is the discretionary versus consumer staple. And this is also a couple of days ago, also the SIROC over here. And you can see the relative strength line also fell. So another sign of weakness. So we're starting to see these red bars are put on here when we get these risk-off signals. A couple of weeks ago, I think there was just one. Now we're seeing a few. There's another in the put-call ratio. So more money going to put and calls. And you can see the SIROC has risen over here as well. So that's just a SIROC on this moving average over here, this annual move, 250-day moving average. And you can see there's the S&P 500 has fallen. This is the bottom chart over here. So another signal, early warning signal for risk-off. Here's another, is 10-year Treasury yields. This occurred on the 15th of April, and which is about 5 days after we did our session. And you can see the SIROC risen over here. This ratio is showing that the yields, relatively speaking, rising are stronger than what the equities were rising, and that's what caused this to happen. Another risk-off signal, right? Looking at the actual bonds themselves, what we look for here is we are looking for a bit of divergence. Because these should move in the same direction. The blue line here is the S&P 500, and the bar charts over here are the actual 20 bond price yield. And you can see how they are moving in the same direction. So bonds falling means yields were rising. A bit of stability is just flattening off over here, because we saw the yields were also flattening off the previous chart. So moving in the same direction here at the moment, which is what they should do. So, no, the divergence that already played out there, which was probably an early warning at the time. The VIX, the fear index, has dropped back into this range over here. It's obviously very sensitive to movements in the actual index. the S&P 500, but that's dropped a bit. But the moving average over here is rising. That's what have I got there? 105, a 21-week moving average. Right, the NASDAQ composite gave an exit signal on the index back on the 17th of April, a week ago, and hasn't yet given a risk-off signal over here, which is the Ciroc of the relative strength line. Yeah, that relative strength line is measuring sentiment between the broad index and the S&P 500 and the NASDAQ composite. And typically in a risk-on environment, this blue line is rising, which means that the NASDAQ composite is outperforming the S&P 500, which is indication from a sentiment perspective of risk on. That's not happening. You can see it's been falling. The moving average has been declining, and I've got a trend line there that's been declining, and now it's even gone a bit further. So that's also an indication from a sentiment perspective that it's keep an eye on this. We've got to get sensitive. We've already had sell signals out of the US portfolios. There's vacant positions available there, and they've happened over the last year and a half or so. So we're certainly not fully invested in our US portfolio, but we're not totally out. And we don't want to be totally out because you want to have some exposure to the market if this is the bottom and things turn around pretty quickly. At the same time, if things do fall, then we've got some of our exposure off the table and more sell signals will come on. If this really does, then our mechanical signals exit signals will fire, and we could end up 100% in cash. In case so that's really how we are. That's how we react to this with our mechanical portfolios. This is the NASDAQ 100. Notice it hasn't given an exit signal yet, nor had the Dow Jones, nor had the S&P 500. So the NASDAQ composite is the only one of the major indices in the US that's actually given an exit signal, according to our mechanical rule in the index. This has the NASDAQ 100 has it. However, the 23rd of March risk off signal that we got, or sign, or I shouldn't say it's a signal, but an indication that occurred when the Ciroc fell below here, and you can see the declining relative strength line there between the NASDAQ 100 and the S&P 500. So the NASDAQ 100 signaled earlier than the NASDAQ composite from using relative strength as a sentiment measurement and ratio between indices, but still hasn't given an exit signal yet using our mechanical timing. So it has fallen below this channel over here. I'm not going to redraw this channel yet until indication of prices go and where the next trough and the next peak forms, if using just price action. But something to note here is the NASDAQ 100 has fallen below 23.6 and has got closer to 38.2 in the retracement of this run-up over here. A little bit more volatility in the NASDAQ 100 with some of these large caps that make up this that are constituents of this index have had some pretty big moves. Just think of Nvidia, Netflix, Tesla, and some of those very large caps, Apple as well. So that was a risk-off signal that had pretty early. Nothing much to see here in the cumulative new high, new low of NASDAQ 100, nor the cumulative advanced decline line, pretty much with the index. Right, this was one that we did notice. This also gave some indications towards the end of March. I'll just put it in here, where we actually had divergence between the direction of the number of stocks that were above their 150-day moving average in NASDAQ 100 and what was happening in the NASDAQ 100. So the NASDAQ 100 was rising, and we had a declining number of stocks above their 150-day moving average. So this is a breadth of market indicator. And that's exactly how you'd use this indicator, looking for divergence. So you got the falling number of stocks above their 150-day moving average and the index rising. That means that fewer and fewer stocks are participating in the rise of the index, indicating weakness. And that was something that we did raise back then, end of March, and see that actually panned out. Divergences don't always, but should be taken as an indication. So this breadth of market indicator was spot on at the time. Right, and now we've seen a sharp rise. You just look at this rise, this run up here of the number of stocks that have now moved above their 150-day moving averages is pretty. You just look at the jump, if you like. The size of that jump is certainly anything we've had for probably 2 or 3 months. Early indication. The SOX, which is the semiconductor sector, and what we do is we measure that against the NASDAQ 100 or the NASDAQ composite. This is the NASDAQ 100. And you can see that it's been falling relative. Now, on the basis, the philosophy behind this is that there are more high-risk stocks, more growth-type stocks in the semiconductor index than what there are actually in the NASDAQ 100, which is actually quite a volatile, which also has stocks that are quite volatile as well, constituent. Right, so what we've seen here is this falling over here of this ratio, which is an indication looking at the line of risk coming off. However, we haven't seen the smooth index rate of change indicator over here, just to smooth things out so we don't gyrate with all these little movements over here. Has given a risk off signal yet, even though there's been quite a fall over there. So that risk, that sentiment indicator there, that sign, if you like, isn't yet showing risk off on that one. Right, onto market. The all odds rising against compared to relative strength compared to the S&P 500. Weakness typically, the all ordinaries index is less volatile than the S&P 500, so that's a little bit of from a sentiment perspective, an indication of risk off as well. And here we've had an exit signal on the all ordinaries index. Our SPA 3 trader would be a risk profile 1 would have stopped taking in when that occurred. The Australian dollar still showing weakness in a big term downtrend. And let's just look at some of the other international indices. The Nikkei has given an exit signal after a good run up, where it's actually retraced 38% spot on it compared to the run up that it had leading into that, and is still rising compared to the S&P 500. But you can see there's been some weakness here over the last month or two relative, so not rising by as much over here and then falling towards the end, which you'd expect after quite a big run up. There's its all-time high line, that black line, so it's fallen back below its all-time high and back into the range, as we would say, and a sell signal there. There's some weakness there. DAX, so we look at DAX and the Nikkei, the Japanese market, as two, if you like, early indicators, lead indices compared to the US. DAX has been very strong. There's its run up. Its retracement has been 23.6, and then a really big rise overnight. So strength coming in there, and you can see the DAX has been outperforming the S&P 500 for some time. There's its all-time highs on this dotted rectangle over here, which I think it's time I can do a solid, which I'll do. And strength, certainly strength, German market, and getting stronger. I'll show you the FTSE 100. The UK have made a new all-time high. You can see that. There it is, right there in the top right-hand corner. A bit of strength coming in. It has not given an exit signal. The index, it's rising and been a real laggard in world indices for many years now, but it's made an all-time high. Don't know what to read into that at this stage, but you can see here its relative strength as it's outperforming the S&P 500. So I don't know. It's been an index that I haven't really taken note of because it really hasn't shown us anything for quite some time. I don't really know what to read into that at this stage from a technical perspective or an intermarket correlation perspective, but we'll find it and see where it goes. Developing markets, just as represented by the Brazilian market, not quite going anywhere, sideways. It's all got above it, worked through, going sideways, and now this as well. Okay. That's where you'll leave the indices. We'll now quickly go across to commodities and have a look at some of these. The Commodity Resources Bureau Index, CRB, sorry, it's not called the Commodity Resources Bureau Index. It was just the B. It's gone with the acronym. Is 50 percentile of this big long down run. Now you can see that this rise in commodities is pretty strong. That it had, going all the way from May 2020. Some consolidation. That retracement relative to this is pretty is pretty shallow, really. But if you go back to the early 2000s, that's what's potentially on the cards with the commodities potentially running higher. So we do want to keep an eye on that. We want to keep an eye on particularly copper, which we'll have a look at in a moment. There's gold, the breakout. This is a breakout to take note of. You've heard me say before, we're going to this breakout and a strong rise in the gold price may be an early sign of the secular bull market coming to an end. I'll cover that in the next probably 6 to 8 weeks. We'll do a secular bull market update. But there may be some other factors at play here that weren't in play back in 2000 when our last secular market started. That's a quarter of a century ago, and one of those is Bitcoin, certainly, and and also the move on other commodities required for renewables, the green, the whole green movement. So we'll keep an open mind on this in terms of this being an indicator of potentially the start of a secular bear market, but pretty strong price action nonetheless, and cannot be ignored. We need to work out from an intermarket analysis perspective exactly what this means. Silver hasn't quite reacted anywhere near. Look how low it is. It is below its all-time highs, and also this hasn't really broken out above its resistance over there. We would typically see if gold goes as strong as it did. So there's the early 2000s. There's the secular bear market period over there from 2000 to 2000, and there was the change. 2013 was over here, and that's what we would typically see in silver. If this really is gold is an indication, an early sign, if you like, an early warning signal of moving into a bear market with equities. So this is one of the things that's, if you like, holding me back on saying that gold is that indication at this stage, because silver would well, and it hasn't. And silver went pretty after gold did. If we have a look at that, so there's the 2001. There was gold, and there's 2001 over there. There's silver. A little bit of a lag, but it does catch up. But we're not seeing that in silver yet. So we're using silver as a confirmation of the gold breakout. If we purely from the relationship with gold and equity and secular bull and bear market. So not convinced at this stage. Need silver to do the same. Right, onto copper, and you can see how strong copper was in the secular bear. So that's where the secular bear market was, and that's incorrect. Secular bear market period over here. You can see how strong copper was in that time as well. And so we'd also want copper start rising as using these three metals as an indicator of secular bull bear. Hasn't made a new all-time high. It did way back. They're pretty strong here at the moment, and people are starting to talk about copper as a bellwether metal again, and are starting to use the term Dr. Copper. It's been out of use for many years, and when you start hearing that term flashed around, people are keeping an eye on the small cap resource stocks, because they are the ones that react, and it's not necessarily only copper stocks. It tends to spill into other small cap resource stocks as well. So keep an eye on that. That's pretty strong price action. We haven't quite seen the reaction yet across in small caps. Right, oil is in an uptrend, matching equities. Nothing more really to say there. There's a role in the CRB index. Onto Bitcoin. Big event, halving, etc., all happened with the miners. Bitcoin miners, again, hasn't quite reacted to that in the way that people have been potentially, but may still. We haven't yet got there was an entry exit over there. I haven't put that in. It's like a one-day trade, but we haven't yet got the Ciroc turning up yet to indicate a long position in Bitcoin, nor have we in Ethereum yet as well. But given the strong run-up that we had here from at basically more than doubled, you would expect there's a breather there, run up, another breather. This is really showing this price action, this sideways movement, this consolidation, this taking a breath, if you like, is indicative of strong price action. So we'd be expecting a breakout either way pretty soon after this consolidation period. You could put a rectangle around there, a Davis box, and see which way it breaks out. But the odds break out to the upside. Ethereum we've covered. On the metals, I'll come to some questions in a moment. This is uranium. It's retracement pretty normal. It's still within the range, the channel, and it hasn't quite got to where it got to back in 2006. But there's also another indication. That was the equities secular bear market was during this period. It's the first half of it. So when equities do start, it's secular bear market, we're going to see potentially some big run-ups, not necessarily right at the beginning of it, but if you think back to 2003 to 2000, which was the first up leg of the secular bear market in equities, that's the sort of thing we'll be looking for in a secular bear market. So it's not shut up shop for 10 to 18 years when the secular bear market does start. We're going to have some big moves in a long-term movement, and that's where to the fore. Okay, iron ore has had a retracement. Remember, we were talking about this 90 to 100 level does need to hold. It seems to be holding at this stage. It dipped down below that trend line and it's risen again. So it found a little bit of support there, but we need a little bit more indication of support than what we're seeing there. And thermal coal does need to hold at these levels as well, and appears to be doing so at the early stage. Right, some questions. I'll just get it back onto the S500 to do a summary. Have you ever considered SCCCO as a copper play for SPA3 investor? No, we can have a look at. But certainly the EP, I think, is a copper ETF as well, but we can have a look. Paul is asking, next DC NXT last Wednesday sold for $12.85. Today it's a bar at $16. And what Paul buy, but I don't get the bit bar, but at bar. But it's just price action. So the first fall and that generated the exit signal was an entitlement offer, which typically does, or rights issue. Similar sorts of things. Whenever a company raises capital, typically it tries to raise capital at a discount to the current market price, which puts downward pressure on the price. And of course, being a mechanical system, or any system really that follows any technical analysis indication, doesn't have to be SPA3 investor, it could be just even generic technical analysis, indicators are going to generate sell signals. And that's what happened. And then the price changes. So it goes up, well, that generates an entry signal. Why? Because price is rising. So that's what's behind it. But, as a mechanical investor, we really follow price action. We don't go looking for the whys. That's a fundamental, and that's fundamental analysis. The whys, the tens, hundreds, thousands, maybe even millions of reasons, if you count every investor reason as a variable, all get put into the price action, and it's not up to us to start pulling apart which why in this particular instance caused the price action to rise or fall. If we do that, well, say goodbye to everything else you do in life, because you need to be looking at every single variable, and there wouldn't be enough waking hours, not only in a single human being's life, but in a group of hundreds of people that are doing this, also wouldn't have time to go and look at every why behind price action. Sure, there will be major whys every now and then, but you could be focusing on considered to be a major why, whereas there's another major why that you have no sight of. It's a total unknown to you. So the best answer I can give to you, Paul, is to go and redo, if you have done, or if you haven't done, go and do the 4-week process and mindset training intensive, because it's all explained in there. And retrading in the zone again. I've just been reviewing that whole training course over the last 3 or 4 weeks, and I personally even amazed at some of this that we got into that course. And it was revision again for me, even though I put myself and Dave material together. So we've got some long-term customers. The training, the 4-week training intent is really does answer your question. And the more we go and look for whys behind price action movement, the more we're going to drive ourselves, because you'll never be able to. You might want to do it once or twice here and there, pick it. But that's not an edge, because you have to execute an edge over a large sample, and the why always change. So which why behind any price action at any given moment is just unknown, except it's an unknown. We talk about the power of not knowing, or Mark Douglas talks about the power of not knowing, and we unpack that in the course. So thank you for asking me the opportunity to cover. Right, to finish up on the S&P 500, themeless, run up, retracement, pretty normal. 23.6% retracement is pretty shallow for a retracement in an index, in an equities index. And now we've got to watch and see where the next peaks and troughs form, and whether that 23.6% support level, if you like, holds for these indices. And of course, on the positive side, if that does hold higher highs and lows from here, peaks and troughs that is, and we make a new line, we get about 5264. It's going to take a few weeks to play out. Then this is up on and upwards. Bear in mind, we've got May just around the corner, a few days away, and all selling May go away is going to raise its, and there's going to be all sorts of discussion around it. We're into the US and typically weakness for stocks and all that. That the seasonality does that, but not 100% of the time. So it's what we're going to do is, those are variables. If you want to put a lot of emphasis and weighting on those variables, well, sometimes they work out and sometimes they don't. What you don't be is on the wrong side of that. You're looking for weakness because the seller may go away and the markets take off and you're 100% in cash. You don't want that to happen. So how do you, from 1 year to the next, this is a pretty long time between May, from one May to the next, is that you follow the price action. We listen to, and that's what we read into. So we got to keep an eye on these retracements. Any other questions? No. Okay, we'll finish there. Thanks for your time, and I'll be back in 2 weeks. And as always, I wish you consistent